SCHD just sold Cisco. It also cut all of the energy stocks. And then it went and bought UnitedHealth Group, and that stock is down 48% from its high. Welcome back to another episode of Almost Wealthy. I'm John, and if that sounds like an ETF that's falling apart, well, I get it, because SCHD didn't do that by accident. The index ran its annual screening process, the same one it runs every year, the same one it runs every March, and the math told it exactly what to buy and what to sell. I pulled the SEC filings and the primary sources, and here's what I found. I'm going to walk you through exactly what changed, why it changed, and what it means to my portfolio, because SCHD is in my growth collateral slice, which means it has a specific job to do in my buy, borrow, die strategy. If you already know what SCHD is and you've seen previous videos where I do the breakdown, here's a quick version. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which is a list of 100 high-quality U.S. dividend-paying companies that have a specific formula. Every year in March, the formula runs again, and this year it made some of the biggest changes I've ever seen since I've been tracking the fund. March 23rd, 2026, that was the date that the 2026 reconstruction took effect. 25 stocks added to the index, 22 stocks removed. That's 47 changes in a single day inside a fund that's supposed to be stable with boring dividend stocks. Here's a quick picture from before and after. To name a few companies, the funds that are gone are Cisco, AbbVie, Halliburton, and others. Ones that came in the fund is UnitedHealth Group, Abbott Laboratories, Procter & Gamble, Qualcomm, and 19 other companies. The energy sector got cut by about 7 percentage points. Healthcare, technology, and financials all went up. And yes, UnitedHealth Group, which was down 48% from its 52-week high, is now in the fund. And it's not a small position. It's SCHD's second largest holding right now at 5.12% for the entire fund. And if you've been tracking this fund, this is the one that got people's attention. Let me explain why. There's no fund managers deciding what to buy. There's no analysts making calls. The Dow Jones U.S. Dividend 100 Index has a formula, and it runs every year, and whatever comes out of that formula is what goes in the fund. So to understand why it bought UnitedHealth and sold Cisco, you have to understand the formula. Step 1, every stock in the U.S. market gets filtered down to the companies that have raised their dividends for at least 10 consecutive years. Yes, 10 years, not 3, not 5, 10 straight years of growing that dividend. That alone right there cuts most of the market out. Most companies don't even have the cash flow discipline to raise their dividends every single year for decades. The ones that do tend to be financially strong, consistent, and focused on rewarding shareholders. Step 2, from that filter list, the index applies for quality screens. First screen is cash flow to total debt. That measures how much cash a company generates compared to how much debt it carries. A high number means the company earns plenty of cash and it isn't drowning in debt. A low number means the company might be struggling to keep up with its obligations. Second screen, return of equity. This measures how effectively a company uses the shareholders' money to generate profits. A high return of equity means the company is good at turning capital into earnings. That's a sign of healthy, well-run businesses. The third screen, dividend yield, the actual yield that stocks pay at the time of the screening. The index wants stocks that pay a meaningful dividend, not the highest yield in the market, but a solid one. Fourth screen, 5 years dividend growth rate. Not just does it pay dividends, but has the dividends been growing? And if so, how fast? This is the screen that separates companies that are going through the motions, that are generally sharing more and more profits with the shareholders every year. The index combines all 4 scores, ranks every eligible company, and takes the top 100. That makes up the holdings list for SCHD. And then every March, it does it again from scratch. Whoever doesn't make the cut anymore is out, and whoever scores high enough now, it will be in. Now let's make a transition into talking about energy stocks that left. VLO was up about 80% while it was in the fund. HAL was up about 46.5%, and OVV was up about 32%. Here's what happened when an energy stock rallies 80%. The price goes up, but the dividends don't go up at the same rate. So the dividend yield, which is the third screen, drops. And when the yield drops enough, the stock's score drops as well. And when the score drops below the cutoff, the index says, basically, you're out. This is the index doing exactly what it's supposed to do. It's effectively saying the stocks have rallied hard, the income is paying relative to its price and is now lower, and there are pretty much better candidates out there right now. It trims stocks that had big runs near the top and reallocating to where those scores are higher. But I want to be clear, this doesn't mean that energy stocks are bad. It doesn't mean SCHD is making a prediction that energy will underperform. It just means that the base of the formula at the moment in time, this specific company is no longer in the top 100. So in other words, this formula doesn't have emotions. The same story with Cisco and AbbVie. Cisco had been one of SCHD's largest positions for years, as long as with AbbVie too. But something within those four quality screens shifted. Maybe the yield dropped relatively to better alternatives. Maybe the dividend growth rate slowed. Maybe other companies outscored them. And the index said, hey, it's time for you to go. Now, the most interesting part about this is that UnitedHealth Group is down 48% from its 52-week high. SCHD didn't just dip a toe in it. It's now the second largest position in the entire fund at a 5.12% of its assets. Ares Management is down 30%, as well as a few others. The reason these stocks are down, regulatory concerns around UnitedHealth, fears about AI disruption, those are some real reasons. These companies are facing headwinds, and the market is pricing those headwinds. But here's what the index doesn't care about. It doesn't care about headlines. It doesn't care about short-term fears. It runs the four screens that I showed previously. And what does a 40% price drop do to a company's dividend yield? It pushes the yield up because the yield is the dividend divided by the price. If the price drops 48%, but the company keeps paying the same dividends, or better, keeps rising it, the yield goes up significantly, which means the stock now looks more attractive on the yield screen. And if the company still has a strong cash flow relative to the debt, still has a solid return on equity, still has been growing its dividends consistently in all four of those screens, and it scores well, that's why UnitedHealth Group is now in SCHD. Not because the index thinks the regulatory concerns are overblown, but because the math said so. At the price, with this yield, with the dividends growing history, this company ranks in the top 100, and that's pretty much it. Going through this document, here's the number that jumped out at me. The stocks coming into SCHD have an average 5-year dividend growth rate of 63%. The stocks leaving SCHD had an average 5-year growth rate of 37%. That's a massive difference. The new additions have been growing their dividends almost twice as fast as the ones that they replaced. And if you're a shareholder, that matters, because here's how compound dividend growth works. If you own a stock that pays at a 3% yield today, and it grows the dividend at 10% per year, in 7 years, your dividends on your original cost is over 5%. In 15 years, it's close to 12%. But if the company is only growing its dividends at 5% a year, you're looking at a much slower progress. When the index upgrades from its basket of stocks with 37% 5-year growth at a basket with a 63% 5-year growth, it's setting up for a much faster dividend growth forward. And that's what dividend growth investing actually means. Not finding the highest yield right now, finding the stocks that are going to pay significantly more income over the 5 years from today. And SCHD reconstruction just raised the average bar on the metrics by a lot by doing these moves. SCHD's overall dividend growth rate went from 8.63% to a 9.38% after the reconstruction. That's the whole portfolio getting faster. Now, SCHD sits in my growth collateral slice. I want to be real clear about what it means to my buy, borrow, die strategy. SCHD has 2 jobs in my portfolio. Job 1, grow in value over time. As the stock appreciates and reinvest dividends compound, the value of my SCHD position grows. The growth value is the collateral. And the more collateral I have, the more I can borrow against without my loan to value ratio getting dangerous. Job 2, pay a growing dividend. The dividend income from SCHD isn't my primary income, but SCHD's dividends do contribute to my blended portfolio yield. And that blended yield is what I need to be higher than my 5.65% margin interest rate. Right now, my portfolio blend yield is 5.23%. And those two jobs appreciate in value and pay and growing dividends. And this reconstruction took a step in the right direction, in my opinion, because it has better dividend growth qualities. A portfolio reflects current market pricing rather than yesterday's winners. My current SCHD position is valued at $1,697.93, and I own 53 shares. I haven't made any changes. I'm just holding. So let's talk about the risk. The index buy and beat down stocks doesn't guarantee those stocks go up. UnitedHealth Group is down 48% because it's facing real regulatory pressure. The government is looking into healthcare costs and insurance company practices. That's the real risk right now. The index scoring these stocks highly doesn't mean that these problems are going to go away. It means that at the current price, after the price has already dropped significantly, the math says they meet the quality bar. They could still drop further. The reconstruction could look like a massive mistake in the next 6 months. Then 2022 was a brutal year for SCHD. It was down 5.56 in total return, and it came back. But past recovery doesn't guarantee future recovery. The other thing I want to name is that SCHD cut in energy by 8% means if energy stocks continue to run, SCHD basically lost in that sector. That's kind of the trade-off of the rule-based index. It doesn't try to predict which sector will outperform. It follows the formula. Sometimes the formula looks brilliant. Sometimes it costs you returns. The 13.06 in CAGR since SCHD's inception in October 2011 suggests the formula has worked, but the past performance is not guaranteed for future results. I'm not predicting. My conviction on SCHD fits the strategy I'm executing. I need a growing collateral holding that appreciates over time, pays a growing dividend, and it doesn't require me to make any active decisions about what I own. SCHD does that. The index makes decisions. Every March, it looks at the whole market, runs the formula, and makes adjustments. That means I'm never holding a portfolio of yesterday's favorites forever. The reconstruction is the maintenance, and that's what keeps the quality bar high. I'm watching the new holdings, especially UnitedHealth, and I'll give the funds time to let the reconstruction play out. SCHD raises quarterly distributions again, back-to-back quarterly dividend raises, Q1 2026 distributions, 0.2569 per share. If you're holding 53 shares like I am, that's around $13.76. That's real cash showing every quarterly from a fund that just updates its underlying dividend growth portfolio. So right now, the bottom line is that SCHG just went through one of the biggest reconstructions in years. 25 stocks in, 22 stocks out. Energy companies cut by 7%. Cisco gone, AbbVie gone. UnitedHealth Group down 48% is one of the new positions. The index just buys quality that's on sale. Is this guaranteed to work? We will see. If you found this useful, please comment, like, and subscribe. I post every week with my actual portfolio data, my actual margin balance with no fluff. Until then, I will see you on the next one.